Hey everybody, Brent Moores here. It's time to cap off our trading week with Market Movers. It's a little shorter session, about a half hour long, and where we talk about the week that was and the week that is coming up and what's going on in the markets. So I'm glad you're joining us. Ben Watson is the usual host of this, but he's out of town quite a bit, so I end up in here helping out. And also Mike Fairborn does too. I think he was on last week, if I'm not mistaken. He's helping me out in the chat this week. So appreciate Mike. You can follow him or myself on X at Mike Fairborn CS, at Brent Moores CS for some additional content. And just remember that the information today is for general informational purposes only. It's not an individual recommendation or personalized investment advice. And all options carry a high level of risk. They're not suitable for all investors. I don't think we'll be hitting on options today, but just remember that the Paper Money software application is provided for educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research. And past performance is no guarantee of future results. You guys all know that. All investing involves risk, including loss of principal. And there's no guarantee of an execution of a stop order is going to be at or near that stop price. So we're going to talk about the general trend of major market indices, what moved the markets this week, and you get the picture here. Let's just start off with the S&P 500 because, most of the week, most of the day, we were actually looking fairly positive on this. And we actually exceeded, this is a 6-month chart, but if I can have an all-time chart here, we'd still be showing high right here. That's an all-time high. We actually hit intraday today. The day kind of petered out on us though. If I go to like a 1-day, 1-minute chart, this is kind of just a big hill there on that right now. And, sometimes it's hard to distinguish how much is news and how much is not, versus just profit taking, I guess, to a certain extent, because there was a little bit of news later on in the afternoon that may have helped to turn the market around to the downside. But regardless of where we're at, it doesn't change the fact that we've been in a strong trend. We have potential resistance here, and until we, even if we're above it a little bit, that doesn't mean that it's necessarily a breakout. But we did hit that all-time high there today on that. So there were some bullish things and some not so bullish things in the market. One of the bullish things was this. Commerce Secretary Howard Lutnick told Bloomberg News that there was a framework between China and the U.S. for a trade deal, and that has been finalized. And so that's a good thing. The market reacted very positively to that. That was before the market opened, we saw that. And so that seemed to price in and help to get us off to a good start today. The White House clarified that an additional understanding of a framework to implement the Geneva Agreement, and that Lutnick added the Trump administration expects to reach deals with 10 major trading partners imminently. And obviously that's a big concern with the markets. Furthermore, what we've been hearing lately is this July 9th deadline that we've been hearing about so much it can be pushed a little bit, is the impression that the White House is giving, that, if people are trading in good faith, negotiating in good faith, then deadlines may get pushed. And that certainly helped push the markets up. However, today on Truth Social, came out this afternoon, President Trump said trade talks between the U.S. and China were being terminated. So that was possibly the explanation for the kind of the sell-off in the mid-afternoon here. Another thing, in general, the market has been going up, but we had some numbers today that came out this morning that were a little bit concerning. We had inflation numbers that came out. We had the PCE number. This is the inflation number that the Fed really likes to look at. And in particular, the core PECE, which is basically strips out energy and food. In other words, those are the kind of the volatile elements of it. Actually came in a little bit high, not ridiculously high, but a little bit higher than expected. And so the market didn't seem to care that much. We'll talk about some of the other economic numbers coming up in a little bit, but the market pushed right through that midday until we started to turn around there. So Kevin said, was I talking about China or Canada? That was Canada, Kevin. The China news seemed to be good. The Canada news, not so good, is basically how that turns out there. Okay, so when we talk about inflation, this all kind of begs the questions of interest rates. What's the future path of interest rates? And earlier this week, and again, I'll get to some economic data later, but earlier this week, we get some softening, economic softening that may have led people to believe. Couple that with some Fed speakers, several Fed speakers seem to soften their tone, a little bit less hawkish, more likely to look for rate cuts later this year. And so, and maybe more this year. So what's going to win out? Inflation, or that's kind of the narrative right now, but the market does seem to be more optimistic there in terms of the interest rate, the potential for interest rate cuts front. In fact, let's take a quick look at that FedWatch tool here. One sec. Here's the CME FedWatch tool. This is for July. Odds are, according to the CME FedWatch tool at least, the current rate, 425, 450. Odds are about 80%, according to this, no change in the July meeting. But when we go out to September, now what we're seeing is an overwhelming likelihood of a rate cut in September. If we go out to, say, the end of the year, we'll go to the December meeting. When you look at that, we're looking at, this would represent one rate cut. This would represent 2 rate cuts. This would actually represent 3 rate cuts there. So this may be shifting a little bit, and you can see down here, more or less steady, but the likelihood here from a week ago of just one rate cut has gone down. So that part of that is those Fed speakers, I think, there on that. Okay, so that's the interest rate front. In fact, let's just take a quick look, and I want to look at other major indices here in a sec. But we have seen interest rates dip lately. You can see the drop in interest rates. We're about to 4.28% on that 10-year note. Okay. Now, one thing to note in the market, if we're looking at the S&P 500, is a lot of this market has been driven by kind of the bigger players in the market. So we're starting to see a little bit of a divergence between the SPX and the SPX equal weight. So let me do this. I'm going to go to just a plain chart, but I'm going to go to make it a percentage chart. Okay, so this is for the year, but let me change that time frame to let's just go out, we'll go out 3 months. And let me go, let's see what, so here's the SPX. Over the last 3 months, just shy of an 8% return on the SPX. The SPX EW, equal weight, about 3% return. In other words, the big components of the SPX, these are the Amazons, the Microsofts, the NVIDIAs of the world, are the ones that are outperforming right now to a significant degree versus the average S&P 500 stock out there, which we can see in that SPX equal weight. Now the NASDAQ, here's the NASDAQ, up about 13%. A lot more tech communications type exposure here in the NASDAQ. No financials exposure in the NASDAQ, up about 13% over the last 3 months. So you see the difference here on that. The Dow, here's the Dow, up about 3%. The Dow is significantly trailing both the S&P 500 and the NASDAQ. Let's look at one more, because there's some news with the Russell. This is the Russell 2000. Russell 2000, a little bit better than the Dow, but definitely lagging the larger cap stocks. By the way, there's a survey link in the chat here. Okay, today was, I don't know, I'm trying to think of the term, Russell Reconstitution Day. Okay, what does that mean? It means the Russell indexes. There's more than just the Russell 2000. This is the one we usually use. This is the S&P 5. This is, the small cap index. But there's different Russell. There's a Russell 3000. There's a Russell 1000 index with large caps. Okay. Well, for large caps, we usually use the S&P 500. But the Russell indexes are reconstituting the stocks that are in them. How does that affect? Well, stocks that are being dumped from the Russell, any of the Russell indexes, that's generally not good news for them if they're dumped from the index. Why? Because there are a lot of funds out there that automatically buy your company if you're part of that index. And so if you're out of the index, you're going to be sold. That doesn't help you. Those companies that get put in the index tend to benefit from those, from inclusion in there. So that has been historically done on a yearly basis. They're switching this year on that just because of more market volatility to doing it semi-annually, doing it twice a year here on that. So there you go. That's the Russell right now. Still, all those major indexes are showing some strength right now, though. And this strength has been reflected to a large extent in the VIX. We're down under 17 on the VIX. I mean, if I go a little bit longer term on this, let's go to 3-year VIX. You can see we're down kind of more an average level, which almost seems like a different world than we've been in the last few months when the market's been kind of crazy, right? VIX down under 17. That's kind of a nice break. For you options traders, the implied volatilities are lower. That may help or may not, depending on the type of option trade there, but that can certainly change that. But our VIX is definitely going to lower levels on that. Similarly, with the market increase, when we look at this, gold's dropped off a little bit. Well, this was the safe haven. And when we were talking about things like, more concern with tariffs, more concern with the Middle East, we had it peak out. Well, right now, so far, so good. Can I say that with the truce between Iran and Israel? I don't know. I have no idea. I have no more knowledge than any of you about what the future of the Middle East holds. But right now, the market seems to be pricing the risk asset here, gold, the safety asset, gold, down to lower levels. Furthermore, if we look at oil and the price of oil, that's dropped down. I mean, that's not as low as it was, but clearly this is when the Israel-Iran situation really blew up there. We're down to a more, a much lower level. Okay, so so I wanted to look at those just to kind of start us out for the day. And let me just look at one more, and that is kind of Bitcoin futures. We're not talking about trading any of these. We're just talking about levels in the market. And, Bitcoin is, it's hanging there above 100,000, below that 110,000 mark. Let's look at the economic calendar, though, of the week that was and the week that is coming here. So let me switch over to this. this is this past week's economic calendar. I'm not going to point out everything on here, but I will point out some of the major things that caught my eye. Number one, on Monday, okay, we had our PMIs, both the manufacturing and the services PMI, which came in relatively positive, it seemed like. So that was one thing there. On Tuesday, we had a consumer confidence number, which really got some press here on this, because that consumer confidence number was a big, big miss on there. And so, I don't know what that means, but with any of these bits of economic data, remember, one piece of economic data does not mean everything. And there's certainly things on here that were on the list. Jerome Powell spoke on Wednesday, and several Fed members spoke throughout the week. That probably had a bigger effect on the market than some of these items here. Our GDP number came out yesterday, right there, and it was not good. It was the third estimate. And just a reminder for you, when we're looking at GDP numbers, they come up with a first, a second, and a third. Okay, so for GDP, the one that usually has the biggest impact is the first. So for like Q4 GDP in January, you'll get the first estimate. Okay, and then February you'll get the second number, and then March you'll get the third, and then come April you end up with the first estimate of the first quarter GDP. And then in May, you end up with the second estimate, June, which is this month, you end up with the third estimate of Q1 GDP. This is the most surprising number. These are revisions. And so really the biggest impact typically comes with the first there. So that's one reason why that may not have moved the market quite as much. And then I already mentioned the PCE. And David, I will answer your question. David's asking where you can find this information. I'll show you in just a minute on this. Here you can see the PCE that we talked about today. Okay. Now, let's talk about next week, and then I'll show you where to find this info. How about, okay? So here's next week. And remember, we got July 4th next week. So Friday is a non-day, and that affected things because your non-farm payrolls report and unemployment report, which normally would come out on a Friday, is coming out Thursday this week. Bigger items to maybe watch for this week. ISM, let's see, we got Chicago PMI. We got ISM manufacturing is probably maybe a little bit bigger. JOLTS usually doesn't move the market that much, to be very honest. You got the ADP employment on Wednesday, but really the bigger ones this week are going to be the non-farm payrolls reports, and there's going to be an unemployment rate with that too. Okay, so those are, and then there's a lot that come in the report. So you get like average hourly earnings and that it can be perceived as like an inflation report of some sort. Now let me show you where to find the calendar here if you're interested. If you're on Schwab.com, go to research, and if you're on U.S. markets, you can. There's actually more than one way to find it. This is how I always go. Just go to the right side of the calendar, right side of the page, scroll down a little bit, there's the calendar section. And I clicked on economic right there, economic. Okay. So research, US markets, scroll down on the right, economic calendar. There's also an earnings calendar you can look at. That's for next week. And let me go and see what we got here for this week. It's not, why is it not showing me everything? Here's what I'm going to do. Let me just do this. Let's go to MarketWatch. I'm just showing S&P 100 stocks, and Salient Joe in the question says, which ones tend to move the market the most? Well, I tried to say that, Salient Joe, the non-farm, for the week coming up, the non-farm payrolls one and unemployment report are the ones most likely. You never know. The ones that move the market are usually the ones that are the biggest surprises, to be very honest. But when you look at the biggest reports, next week, probably that non-farm payrolls report is the one that, with the numbers associated with that, that are most likely to move the market the most. Also, the ones that tend to be the biggest concern in the market right now. Let me give you an example. For several years, inflation wasn't even a concern. It wasn't even that big a deal. Right now, and for the past few years, inflation has been a huge deal in the market. So reports like the PCE report or CPI, which we don't have last week or this week, CPI, PPI reports are ones right now that really tend to move the market a lot, because it doesn't just tell us about inflation. Those also tell us about potential monetary policy as well, Fed policy, right? So those are the ones that tend to, move the market. Those that are talking about inflation or talking about economic recession or economic health. Okay. There we go. Okay, so here we're on the Thinkorswim platform. I'm going to MarketWatch. I went to Calendar. I'm just looking at S&P 100. And we had a couple that are, biggies that maybe made some news here. Let's look at them. So FedEx and Nike came out here just over the last, I think FedEx was Wednesday, and then Nike was yesterday. Nike was the 26th. So that must put FedEx at Tuesday, I think. Okay, so FedEx and Nike. Let's just take a look at the stocks real quick. Here's FedEx, FTX, and here's the stock, and you can see it went down. Now, the interesting thing is and this is the same story we often get on these earnings reports, is what they do on their top or bottom line doesn't really matter as much as what their guidance is. And they actually beat on their top and bottom line on their earnings, yet the stock dropped. Okay. And what FedEx said is, well, this is what a lot of companies are doing, by the way. We're not willing to there's enough uncertainty in the market. We're not willing to forecast as far out in the future. We're only going to go one quarter out into the future in terms of guidance now. The market didn't like that. They took that as kind of a negative, and therefore, the stock kind of got smashed a little bit there on that one, sold off on that news there. So that was Nike. Now, that was FedEx. Now, on the other end of the spectrum, Nike, which has really had a really hard time. I mean, let me go to like a 3-year chart here. Look at Nike. Now, I mean, that's just not good. I mean, it was up at 131 back at the beginning of 2023. We're down. Well, we jumped. We made a massive jump up to 72 right now. So that's a nice jump on it. And the thing is, sometimes with companies, expectations get lowered so much. So much bad news is factored in that even, then you set yourself up for what, 15% gain today on this. Nike said they're expecting a $1 billion headwind, $1 billion headwind from tariffs there. And, they're trying to change production and whatnot, but it's a challenge, okay? Well, the thing is, everybody knew that. maybe not the exact number, but everybody knew tariffs were a big, huge issue for Nike. Everybody knows Nike has struggled with competition, more competition of late. So once that's factored in, it gives you more potential for a big jump. Nike did beat bottom and top line as well there as well. Okay. So earnings for next week, nothing really. We are in the calm before the storm, so to speak, in terms of earnings. We had FedEx, Nike this week. Notice the next one. This is S&P 100. So S&P 500, there'll be some, but these are the 100 basically biggest companies. July 15th. July 15th is basically the start of earnings season, our next earnings season. So that's when you get this slew. I mean, if you look starting July 15th, the week, look at all these are big names that are coming out at that point. But between now and then, not much on the earnings front. Let me just show you a couple more things here before we wrap up. Number one, Boeing. Boeing had a nice day, okay? Boeing was upgraded, up almost 5% today. And, don't look now, but Boeing's actually been doing pretty well. I mean, we had a low of 128 back in March or April, I guess. We're now up, I haven't doubled that yet, but we're up to 212 there. And I'm not going to recount all the woes that Boeing has gone through over the last few years, but needless to say, this does seem like a substantial difference. They were upgraded by Rothschild and upgraded to buy from neutral with a price target of 275 up from 180. Okay, price target 270. So they had a nice little jump. Estee Lauder was upgraded, up 1% today. Not quite as nice as Boeing, but a nice little gain, even though the candle itself isn't a real strong candle, even though it gapped up. We closed right near the bottom of the day there, but they had an upgrade from HSBC, upgraded from hold to buy. And we'll hit a couple downgrades and then we're going to probably call it a day here. Here's Uber. Uber had a downgrade. Canaccord downgraded Uber to a hold from a buy with a price target to 84 from 90. And at the same time, they downgraded, and this is something that we often see, they downgraded Lyft. And so a lot of times when analysts are upgrading or downgrading companies, it's nothing to do really with the company, it's with the industry. Okay, so you'll see like a whole set of banks upgraded or downgraded on the same day by the same analyst. It's not that particular company is bad, it's that the industry is struggling. We see Uber and Lyft being downgraded in that same way. Just a reminder, we do have a survey link in the chat. If you fill that out before we go, final look at sectors, sector performance. This is today's sector performance. Discretionary, industrials, staples near the top. Over the past month, IT, communications up near the top. Energy doing well, no doubt in large part to oil prices. But you can see why some of those large cap, why the NASDAQ is outperforming a little bit when you see those industries, those sectors outperforming there. Okay? All right, everybody. Thanks for joining me. Thanks for joining us this week. Michael, thank you for helping me out in the chat. Of course, always. Everybody have a nice weekend. And we're going to see you all next week. Bye-bye, everybody.